The stream is live. Let me go ahead and drop the link at the top. Yeah, Alicia, I decided to keep going with the just chatting for a little while. We're gonna test it out for a few more months. We're gonna see what's going on there. We have the opportunity to do better in that regard. All right, shout out to Genia. Good morning, good morning, good morning. Look, I know what it's supposed to say. Don't you hate auto text has become the worst enemy of the people. It used to be so good, right? That's where autocorrect used to be so good. Then all of a sudden it just started like it's like it's targeting you now, you know? The link is at the top, guys, for the Twitch if you want to pop on over there and see what we're talking about. All right. Um, let's get to this. I want to talk about some of the stuff that we were just speaking on for sure. Let me go ahead and bring my comments up so that way I can see any comments that's popping up. I'm still in my dashboard right now, so you can see the charts, but I'm not necessarily on that particular screen right now. You're not going to start with me today. We're not doing it. Okay, carry on. I'm not messing with you. Thank you very much. Um, okay. All right. Data. And I got my comments up and booming. All right, we good to go. Again, for those on Clubhouse, you can see the Twitch link at the top of the room. All right, let's talk about it. All right. So Ray, I do want to point something out, right? So because we were talking about realized versus implied. Right? This is a conversation of volatility, and I actually, recently just shared an entire PDF on understanding volatility. It's like I don't know if you saw that one, Ray, or not, but it's in the Telegram. I'll pin it to the top for those that Yeah, I was on that or that evening. I think you did it in the evening last week. Yeah, like last Thursday. Yeah, I was on. I learned a lot that day. Excellent, 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 excellent. So now, so we're talking like right now in the market. Realized volatility is rising. Implied volatility is relatively subdued. The VIX is subdued. All right. So I there's a few ways to look at it. One way is, of course, that means that we have a divergence. Now, I don't know how to interpret that divergence. I'll be clear with you about that because that's a whole other level of divergence, right? And what I mean by that is like I couldn't give you any directional like observation about that. Right? Usually, when you experience a divergence, you could tell what direction it's implying, right? You have bullish and bearish divergence, right? Well, for the most part, Now y'all notice. I want y'all to notice something. Okay? She wasn't doing none of this until she knew I was on the stream. I'm telling you, this dog, she's anti, she's an anti-establishment, type of animal. Y'all been rooting for her, but y'all peeping this. Did y'all hear any barking before I said, the stream is live? Did y'all hear any barking before that? Y'all ain't heard nothing. All right.
Nothing. Absolutely nothing.
Then the stream went live. And then all of a sudden, she's Miss Barks a lot. I'm just pointing this out. Pointing this out, man. The dog has a scheme. Scheming. What's up, Prince?
Hey, what's there? Something, right?
What's up, man? I see you, man. I see you, man. I see you, man. Took your brother out, man. Took your boy out, man. It's all good, man. I mean, you could have had a worse game and still won, bro. You ain't had to do it like that. It's okay though. It's okay, man.
I almost gave up. So, but
yeah. Go figure. My quarterback says, "Oh, okay, we want to play badly. I see you, and I raise you." Yeah. Yeah, man. He decided he wanted to parlay too, man. But so again, so realized volatility rising, implied volatility falling or flat. It's a divergence, but like I said, it's a non-directional divergence. So you really, I could make presumptions and say, well, if implied volatility rises, that must mean the market's going to fall. I could make that assumption, right? We could start to make the assumptions that if there's a divergence happening, then the opposite must be what's implied, right? We must be facing this resistance here, and boom, collapsing coming, right? We could make those assumptions. That could happen, but let's not do that. What I will say is it's possible that the market, in this regard, when you see this type of divergence, is underpricing and understating risk, right? Which is why we, even though we're rising in the market, we did not close out. We did not close out all of our VIX position, right? We closed out a part of that VIX position, but kept the rest of it open going into next year, because now, again, I'm giving, so listen to the interpretation. So your market is saying, we kind of fine with what's happening right now, right? The realized volatility is rising, but it's not having any impact on implied volatility whatsoever. So the market is saying, okay, hey, normal days, right? This is fine. We can work with this. That's kind of what the market is saying right now. We can work with this. All right. So that's my usual interpretation when I see that. Ray. It's just, simply put, let's go over here to the pro pivot indicator. See right here, the past 5 days, realized volatility. This is for the QQQ. We can go to, we can go to QQQ on the bar chart as well. All right, you can see, all right, they are just as low as the as the S&P is, all right, just as low. All right, and I do believe we're still Like it is a very skewed environment because you have volatility contraction while you're having you know a range expansion at the same time. So this tells us this is a very big, like it's a wider range contraction of volatility. So you're getting bigger swings, but overall those bigger swings are not as big as you know. So you see here, people still consider this to be a pretty big swing, right? This to be a pretty big swing. This to be a pretty big swing. You still make that consideration, but overall, what's happening to the market? Look at it. Here, 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 here.
Stagnant.
All right. Well, so they call this a coil. All right. So it's a volatility contraction pattern. All right. So the swings are big enough that they're bigger than the swings over the past 20 days, but they're not so big that they create a shift or a swing in the market's expectations. So the market is saying, we like it, but we expect less in the future.
How much weight do you take on that lower low there in November, though? You know what I mean? Like the fact that the market went significantly lower there and then rebounded quickly. Do you take did the market sort of say, hey, went lower and then we came up and made that now recent low, which was of course higher? How much weight do you hold on that middle low there? Because I feel like that was pretty significant.
No, no, because this low right here, it didn't actually shift the volatility structure. I'll put it like that, right? Since we're talking volatility, it didn't shift the volatility structure, right? And here's what I mean by that, right? So we keep track of this monthly trend here. Excuse me. To see 590, let's go to the QQQ here. Oh no, I'm sorry, I already have it open. Okay, thought I was on the SPY on the chart. So the QQQ here, yes, you broke this low, right? But I can't tell you how many times I've seen a change of character that led to a push right back into the range, right? That didn't really work out or pan out to anything, right? I've seen it a million times. I think most of the time it's because the volatility structure doesn't change. So you can't only watch market structure, you have to watch volatility structure as well. So let's say, I'm just going to give you an example, right? I'm going to use some trend lines here just to make this example more clear. So let's say during that time period here, wait, actually, no, not there. Say that. So during that time period, let's say here and here. All right, let's bring that down a little bit. It's a little higher than the other one. So let's say from a volatility-based perspective, these two key levels hold the trend in their hand, right? We break this level to the upside, it's more of a clear sign that we're still in an uptrend. We break this level to the downside, it's more of a clear sign that the market actually is prepared to make a move lower. Let's say that's what we're experiencing. All right. Well, then that makes this less significant, right? So sure, you get yourself a change in character, right? But even with that change of character, what you fail to do is change the volatility structure. So what happens is this level here doesn't really budge, right? Meaning things would shift to like this, right? You already broke this level, so now we start looking forward to this level here. But instead, nothing really changes. You're still in that same range that needs to see some obstruction in order to really, in order to really see a shift in the market. So that's how we look at it, man. And so we're able to, and that's what makes us able to really operate and trade the way we do, because essentially that was fool's gold, if you want to put it like that. Right? That was fool's gold. It probably made a lot of people feel like, oh, it's over. Right? In reality, it gave us the perspective of, nah, it's not over yet. It's potentially a reset. Right? And we'll have to see. So the market can, again, it can prove things to you by, by just shifting the volatility structure, right? Let's break back below 600. Right. Let's be persistent here. Let's all right. If you go back below 600, you're below all averages again. This time, let's stay below all averages. Pretty simple, right? This time, let's stay below all averages. Prove it to me. All right. Again, these is what creates the shifts in the volatility structure. Then fall back below the 5-day trend again, and then we can talk business. And then I'll be like, okay, let's short this bad boy. All right. But until then, the longer term trend persists. Hong, good morning. Good morning, Moji.
Yeah, good morning.
How you feeling today?
Good morning.
So, do you analyze based on the chart, or do you use any other indicators?
Savannah, Maya. Yeah, no, it's not purely based on the chart. For the most part, I like a combination of fundamental and technical factors. You have I don't know if you're familiar with heuristics, right? You have certain heuristics in economics that work out really well. Like this morning, we were talking of the good news is bad news narrative, but overall, we're looking at a market that's likely to continue to respond positively to bad news, and it would appear that we've had more bad news in recent times, right? That have led to the Federal Reserve wanting to continue to lower interest rates, right? So unemployment rising, a less stable employment environment overall, all of these things here. So, what we do is we use the economic situation as a form of heuristics in order for us to be able to look at these charts and look at the market and see it with a essentially with a more clear lens. So, like what we were just talking about when we saw these lows in November, right? Another way I could break that down is, well, for right now, even though we saw those lows in November, the economic narrative had not changed, right? We were still looking at the market in a sense of like expectation of interest rate cuts, and that's been driving the market higher. So until that narrative really shifts, when will the market actually shift? Right? Do we believe that this sudden, shift in sentiment about AI is going to last, or do we believe that people will get back to believing that these semiconductor names like Nvidia are going to live up to expectations, right? So things like that, man. Outside of the technicals. we can
Because
see
you
those.
mentioned about many different things like unemployment rate and the rate cut and the expectation of the market and bad news. So how do you, you know, look at it when the unemployment rate is going up and also, rate cut, we already, have it and likely there's gonna be more rate cuts down the line. And yeah, so how do you, uh, you know, apply that to the, trading?
Yeah, definitely. So we can use the last rate cut, not last rate cut, the last unemployment information as an example, right? So in in this type of environment, you have the GDP numbers are still strong. I don't know if you're looking at the stream here or not, but for those that are looking at the stream, I'm going to pull it up real quick. I'm going to pull up the GDP now.
The link is at the top.
Yeah, the link is at the top of the room for those that do want to pop on over there. Right? So you can see here, um, third quarter GDP is expected to be 3.5%. That's well above average GDP, and I'll let me pull that up real quick here. So GDP. All right, there we go. Real GDP per year. Oh, wait, hold on. Okay, there we go. So you can see the average is closer to 3.2%. Median is about 3% there. So when we have that average GDP growth, Hong, that's considered a stable environment that the market can thrive in. So the greater percentage of the time, the market's going to be moving to the upside. Now, you come back to the unemployment. The unemployment numbers are going to have an impact on interest rate decisions. So if we start to see a weakening of the labor market, the Fed is going to want to stabilize that with lower interest rates. All right. So now we have a market where GDP is strong and we're talking about lowering interest rates. That's only going to fuel more economic growth from a theoretical perspective, right? We're going to say theoretical because the market is going to move based on theory first and deal with reality later. Right? So from a theoretical perspective, if unemployment rises, hey, cut it out. From a theoretical perspective, if the unemployment rises while the market is while GDP is still strong, the market will respond positively to that. So how we can trade that is we can say, okay, cool. We have unemployment news on the way. We could look at the trend. And so we've been talking about this recently, like just focusing on the trend, right? The trend has been that when these, with these information that's been coming out, almost everything has been leading to more rate cut expectations. So when we see that the unemployment news is about to come out, we don't have to change those assumptions. We stick with the trend, right? The trend has been most of the economic data has been leading to lower interest rates. So we're going to think along the same lines of that trend. So depending on where the market is, and in this particular case, the market was down around that time. What do? We say, okay, cool. We're going to take a long position ahead of the unemployment news and ahead of the Fed decision. And we're willing to hold it. We're willing to hold this market through both of those economic events. because clearly the trend has already been revealed. All right. So it's a very easy way to trade that economic data without and just for the record, we don't have to go digging and doing research before we do it because we're continuously researching, on a regular basis. So, that's the other part of it, Hung, is that these aren't long drawn out decisions, right? These are decisions that are made, right? Like that. Because we have an understanding of what the economy means to the market. We have an understanding of how to position for that. And, we're gonna go with the standards, right? We're not gonna try to reinvent the wheel either. Right. So the standard says that as long as a trend exists, it will persist. Right. When it ends, it ends. But as long as it exists, it's gonna be persistent. So for now, we're gonna assume that the unemployment news is gonna continue to push the market higher for now. That's gonna be our assumption for now. Right. Um, Now, could there be a pause on maybe the next one, things of that nature? Sure. Right. But we're not gonna do too much assuming. Right? Maybe we position a little bit differently the next time around and say we take a neutral position. All right.
So if you have a long at this time,
Mm-hmm.
and like like percentage wise,
Mm-hmm.
what's your conviction at this point? Like 85% likely it's gonna keep going up, and 15% chance to fall down. Like how could you say?
I'll put it a little bit lower. I'm gonna go at more like 70%. It's gonna keep going up, and 30% we might see it come down. I'll actually say it's a little lower than 85. Right, but 70 is good for me. Go ahead, talk to me.
30% chance to fall down to where? Like to previous low or further?
Um, so in the earlier stages, right, of that whatever downside that is, you're looking at maybe like a 6%, 5 to 6% drop here. And that's based on we were just talking about volatility, right? So as I look at my volatility ranges, and actually, well, no, let me rephrase that. Actually, more like I'd say more like 4%, 3 to 4% actually. Look at my volatility ranges right here. I was thinking about the triple leverage. But yeah, so like maybe like 3 to 4, maybe 5%. Which these are pretty these are pretty normal numbers.
So 3 to 5% chance to go further below the previous low.
No. Like a 3 to 5% drop.
Okay.
So and then from there you can kind of measure that home to see if that takes you below the previous low. So for example, if I measure that right now, let's measure 3 to 5%. Let's see if it takes us below the previous low. Let's see. From here, let's go 5%. So 3% takes us right to the previous low, just for the record. It takes us right there. Okay. And then 5% gets us close to the lows of November that we were just talking about, but not quite there. Not quite there. Right. And it just happens to be enough to close a gap that we see right here on the chart technically. These are all great questions, by the way, man. you popped in. What's up, Yolanda? What's up, Anisha, Ludwig? What's going on, guys? Any other questions you have for me, home?
Yeah, so so when unemployment rate keeps going up and when the inflation rate also keeps going up, then macro wise, what's gonna happen?
Well, that's going to be first of all, that's going to be a tough one on the Federal Reserve, and even inflation actually surprised to the downside recently, which fits the narrative that we were just talking about. That most economic indicators have been coming in to support lower interest rates. I do believe there's a chance of what you just said, though. I do believe there's a chance that unemployment keeps rising, but inflation starts to pick back up. Right now, I do believe that's going to lead to some softening of the sentiment in the market. So essentially, in the short run, we start to sell off bonds. So it's going to be bad for those who maybe recently just bought bonds, but it won't matter much to those that have been holding on to bonds for the longer run. And it'll put some stress on the banking system, of course, because when you have a sell off in bonds, that kind of diminishes the value of their reserve holdings a little bit. Then from there, I do believe you'll see some stress in the markets as well. We'll see the market actually start to tick lower, right? Because I mean that's just the normal response, the normal reaction in this environment, right? Because you're going to end up with slowing growth but rising inflation. So, well, you put those two things together, they spell out one word that we all hate, and that is stagflation. Right? Because if unemployment's rising, then the growth will start to shift. Right? It'll start to shift to the downside. If it keeps rising, I should say, right? Because rising unemployment has two effects. It has a longer term impact on growth expectations, but it has a shorter term impact on interest rate expectations. Right? So rising inflation would then kill that narrative of lower interest rate, and then you would have to focus more on the growth. And once you have to focus more on the growth, it's a wrap, man. I would just stay long volatility and look for the market to start to come down from there. And I would have no problem basically taking my profits off the table and just being short the market in that moment. Hung. That's how I look at it. So rising unemployment with rising inflation, we're going to have an issue. Market's going to have a hell of a sell-off.
So how do you trade? Do you trade in like in my case, usually 2-year term. So once I buy, I usually hold at least for 2 years. Like in your case, how do you trade?
So on the investment side, I would look at it more like that. On the trading side, I deal with multiple time frames. So on the position trading side, and that I tend to position trade more outside of environments like this. Environments like this, I think, they tend to lead to profit taking a lot more often. And I think people should lean towards profit taking a lot more often in an environment like this. It's heavy uncertainty. But on the position trading side in a normal market, you know, I would tend to look towards maybe like 12 to 13 months of holding so I have what's called my core position, right? So my core position would be there pretty much the entire year, right? So far this year, my core position, I don't know, when do we take that VIX position, guys? It's been there for about 6 months at this point. Right? I'd say probably about 6 months. So I always have a core position home. So that core position deals with whatever I think the environment calls for. So, for example, in this environment, I think it calls for always being hedged, meaning always being prepared for an abrupt shift to the downside. That's where we should be right now. So my core position is in the VIX right now, and it's going to focus on that. In a more normal time, my core position would be in the SPY or the S&P 500, and then I build around that. So I usually grab a core position and I build around it. All right, and when I build around it, those can be shorter term positions, medium term positions. It could be whatever. So my core position either focuses on the primary trend or the primary risk. All right, let me pause on that part. Does that make sense to you?
Yeah, and you mentioned about uncertainty. Yes, we have uncertainty. I believe all the time. There was no time, not even a single time, there was certainty for everybody.
Yeah.
If that happens, that's probably at the peak of the market, very likely.
Mm-hmm.
And so, um, the sentiment wise, that most investors feel the fear and more uncertainty. I'm kind of leaning toward bull market, because I believe that going against public sentiment has been really working for me. So at this time, it's a good idea to go against the public sentiment, which is having long instead of short. So yeah, right now, like I'm fully invested, and it's likely that in case of the crypto market, it really tanked, whereas the Nasdaq and S&P 500 didn't really tank as much as crypto. So I'm actually leaning toward more on crypto over stock market. I think stock market will likely go up, but it's not gonna go up like explosively. Whereas I expect the explosive move from the crypto market. And I think those who have fear in this market, probably gold is a good hedge. I don't think gold will ever collapse like stock market or crypto. Gold just keeps going up. I think very likely that gold will keep going up because we are expecting more rate cuts. In 2016, 2026. Also after the Jerome Powell ends his term, when the new person comes in, he's likely gonna favor the current administration, which means that a new person will likely even cut even more aggressively. And so that will be priced in pretty soon. So I'm actually expecting aggressive bull market. not in. I mean, even that could happen to stock market because I think a lot of people are in fear of the AI bubble popping. I never actually saw any bubble pop when everybody expect bubble to pop. When bubble pops, it's usually when everybody believes it, when there's no uncertainty. But right now we have uncertainty, which means very likely the market is gonna keep going up.
Yeah, I like your thoughts, man. Certainly. I like your thoughts. Yeah, man.
One thing that I little bit worry about is I look at AAII, the average American investor sentiment, and recently the last 2 3 weeks, the sentiment is kind of too positive, and I wanted that to be more pessimistic actually.
Yeah, yeah. It's usually a inverse, right?
Right. So that's one thing that I worry about because when average American investors are positive about the market usually doesn't go that direction. It goes opposite direction. So that's one thing that I'm a little bit worried about. Also, the sentiment all of a sudden became kind of neutral at this point. Just a few weeks ago, like everybody was in fear, but now, like all of a sudden, like a bit positive. That's something that I worry about a little bit. So yeah, I'm leaning toward bull market, but I would say 75 and 25%. 25% possibility that it's gonna go down heavily. And then after that correction, it may go back up when after shaking out all these average investors, when the average investors sentiments go really bad, that's after that likely market might reverse. Yeah, but that's the scenario. So, but I'm more leaning toward the market just keep going up.
Yeah, definitely. So then we are definitely in agreement with that, huh? So you're 75, 25. I'm more like 70, 30. Right. Like I said, so yeah, we're in agreement, man. I think, I just think that everything is um essentially just set up for the market to continue to move higher, you know. Uh but like you said, if it does fall, and I think the reason why it's going to fall hard, hung, is because it's going to take something of a of an extremely negative nature to really bring it down, right? Some sort of a negative shock that's going to really bring it down, whatever that may be. And so, of course, it would fall dramatically at that point. You know, we have yet to see what that's going to be. And not only that, and you mentioned recovering quickly, and I believe that will be the case only if that negative shock does not impact um, GDP projections, or if GDP is still strong around that time. Basically, if there's no recession implications that come along with that negative shock, then yes, you'll have another quick recovery, and I'll be I'll be right there prepared for it as well. Those are the times, hung, where my core position turns into along the market. But every time we get back to these highs, I think it's best to remember that we're in a market where the we're in a market where the valuations, and I don't know how you feel about valuations, but for me, I don't look at them as a short term indicator. I look at them as a medium to longer term indicator of things. So when I look at these valuations, there's only one other time where valuations have been at this point, and we can say that, in this environment, there's only one specific thing that really holds us up, and that's the fact that these companies today are more likely to live up to the expectations. More likely to, doesn't mean that they will, right? It's more likely that NVIDIA will actually achieve the things that they said they would. And so that the prices that we're paying may not be as, we may not look back at these prices as being so bad. But if we have to drive the market higher, if we go beyond this point, that's when we're going to be paying so much for the market that then when you look back on that, you'll say, well, okay, maybe we overdid it. Right. So I think we're at a point where the market is pretty much priced perfectly, but at the same time, that becomes a problem later on down the line. If we see companies in the slightest bit, fall back from expectation, Google gives us 1 percentage point less than they were supposed to give us. NVIDIA, loses one major client that we didn't think they would lose, or anything of that nature. The cards are going to come down, and these valuations are going to be stripped away from these companies very quickly. It's not going to be, and that's why my main position right now is focusing on the primary risk, because I believe the risk outweigh the reward right now. I want to know your thoughts on that, by the way. Yeah, like, do you believe that the risks outweigh the?
Yeah, I agree with that. Yeah, most stocks are already priced in, and like what you said, just a right price, like it's not higher or lower. So yeah, unless I mean, as an investor, we have to kind of look ahead of time, whether there will be more sales or less. And so, the unemployment rate is rising, which means all these corporations are laying off their employees. Does that mean that they want to have some cash just in case something happens? Or I mean, obviously, when they have more money, they will likely hire more people. They will expand. But it looks like these corporations are like preparing for the worst case scenario. It looks like the tech companies. I don't think it's because of AI. I don't think the AI adoption has nothing. It's very little to do with the actual layoff at this point. It may be more significant, uh, years from now. But at the moment, I think it's more likely that these corporations are preparing some cash when the winter comes. And I witnessed that many times, even in my country, South Korea, that these big corporations, they usually prepare cash and for the winter. And those companies always survive through the winter, but the companies just kept expanding the corporations. Some of those even went bankrupt. So it's probably time for these corporations to shrink their size. That's probably the reason why they're laying off. And so that's why I also am a little bit cautious with this market. I think it's better to be more cautious than too bullish or optimistic.
Yeah. Yeah, most definitely, man. Yeah, so I appreciate the, the like essentially the conversation that you brought to the table. It's, you know, I think we needed to have this conversation actually because we hadn't gone down this route in a while. Right? We hadn't gone down this route in a while, and I think I think there's people in the room that needed to hear some of this. Because yes, as you said, as I've said, we do believe the market is primed to move higher, but it's gonna move higher into greater risk. But by that time you could have already, you know, established yourself. And I'm fully invested myself as well, still, by the way. I don't think anything is happening right now that needs to, uh, see a shift in how you're positioned. But
I also think it's key to bring it to point out too that depending on people always make comments about sort of what they think the best sort of like where we're going or whatever. And I think it's key is what you're doing because you mentioned trading versus investing. Right? I think it's key to sort of understand that people ask questions a lot. Where are we going? And it's like, well, like I told somebody recently, an 18-year-old, it's like, well, the advice I'd give an 18-year-old is a lot different than, if he's talking about, investing for his future down, like retirement. Well, that's a huge, you got 50 plus years potentially, right? So that's a much different conversation with somebody than, hey, I'm a day trader or I'm a swing trader in the market and I'm trying to take advantage of some moves, right? So there's so many different sort of ways to, attack it. And that's why I think, the sentiment can be one thing, but then it's also sort of individually down to your own, whether you call it a strategy or whatever you're looking to do, invest, trade, whatever. But yeah, I think it's important to sort of differentiate between the two or multiple different strategies or whatever.
yeah, definitely. Speaking of that, like so from a shorter term perspective, and that's like so when we come into this room a lot, the goal is to focus on the short to medium term in like throughout the daily session, and then focus on the medium to longer term in our nightly sessions, right? So even like right now, Ray, here's what I'm seeing. I'm seeing. I'm first of all, I'm loving the fact that we did this yesterday. We actually set these midpoints on the 40-day retracement because now we're trapped up right here at the 620.74 on the QQQ. So today the high was 620.71, just 7 cents above that level. So now here's how I look at that, right? Let's go to the smaller time frame real quick. And so let's just get an understanding here, right? What happened and what did not happen, right? So I'm going to put this level here first, 620.64. I'm just going to drop that there and gotta remember to make you click it now. All right, 620.64. So let's talk about what happened, what did not happen. So GDP numbers come out, market falls a little bit. Once market opens, we actually pop and we push to the nearest key level, 620.64, right? Now, once we start to fall back from that level, right? So we rejected higher prices at that point. What did not happen was a break of, let me just double check this here. So what's the low of today? 617.78. What was the low of yesterday? 617.77. Right? So what did not happen was a break of yesterday's low. That's what did not happen. Right now, obviously, then that means we didn't get a close below that level either. Right. So now we're just kind of looking at a market in a range now, and you got to really be careful about this stuff. Right. So if you want to trade in the short term or any time frame, what's one of the things I said to you guys? The first thing you need to recognize is what? You gotta recognize the range first. All right. You gotta recognize the range first. So as you can see, now we're in a range between right the high of yesterday and the low of yesterday, but we've just revisited the low here. If we keep revisiting this low, eventually what's gonna happen? All right. Eventually we're gonna go ahead and we're gonna bust through that low, and it just kind of is what it is. So, but yesterday we tightened our trailing stops on our shorter term positions there. So that's a good look. And so we'll just kind of hang tight here because there is no trade you should be taking right now, right? Because you had to move higher to start off the day. Second candle just pulls you right back into the range, but you did not get back to the other side of that. You're not you're not looking at a close below the bearish key level in any way, shape, or form. Right. So in reality, this is a hands-off market for right now today. Now, obviously, we already have long positions, so we're already long the market. So it's hands-off on the shorter term trade, but it's stand firm on your medium term that you're already holding. That's the way I see it today. Just hold on to your T triple Qs and leave this market alone today. I also want to point this out. The VIX has been dropping this entire time. If y'all have not been paying attention to that,
I noticed that.
VIX been dropping this entire time. The entire time we've been talking, the VIX has been going lower and lower and lower and lower. Right? So there's that divergence we've been talking about, that implied volatility divergence, right, from the realized volatility. So again, to me, this says like the market's fine. The market's like, okay, we're cool with it. We're not panicking. Right? That's what it says to me. Right? The market's not in a panic over what's happening today. So even more of a reason to just kind of fall back with the market, handle its business, right?
I guess, I'm also monitoring the volatility, the VIX, and it's gone down, really down at this point, which means it can spike up, right? But yeah, the VIX going up doesn't always mean the market going down, and it can push market up as well. I'm just trying to be optimistic because overall sentiment is down. I'm just trying to think, like differently. But yeah, but Ray mentioned about depending on the time frame, everybody have different strategy. If your goal is maximizing your return when you retire, that's totally a different story. And I'm sure that here nobody's talking about day trading, but probably swing trading, like between months and then between 3 to 6 months. I do some swing trading. I don't do it with stocks. It's not really as volatile as crypto, so it's actually easier to do. I mean, more profitable with crypto with swing trade because crypto is more volatile. So with stocks, I usually have ETFs. I usually don't touch stocks. It's a very, very long term investment. Whereas crypto, like I do swing trade, and even though I lose there, like it's still okay. Like I, use only about 30% of my portfolio is in crypto. Um, but like I want to give more emphasis on crypto. It's gone down so much compared to the precious metal stocks. So I think crypto will likely have good chance to go up. And I see that a lot of here in the crypto market, a lot of pessimism. Whereas stock market, like it's somewhere like in between. Like it's not really pessimistic at the same time. It's not also optimistic. It's somewhere in between now. So uh, yeah, that's how I see it. But that doesn't mean I will sell my ETFs or something like that. I will likely just put it there. Yeah, but if everybody suddenly like jumps in, if the market start going up like aggressively and everybody's jumping in, that's probably the time that I will be selling. Uh, yeah, start selling, not everything, but at least taking profit and then waiting. If correction comes, then I can buy back.
Yeah. So for me, what I look at as selling is like more like profit taking and whatnot. So I usually like a combination of factors, for making a decision to sell. So, you know, um, well, again, in selling, I mean profit taking or taking profits, right? There's usually a combination of factors, that I need. And like one of the first ones that I need is I need for the market to hit an extreme, you know. So hitting a extreme on maybe a momentum oscillator or from a momentum perspective. So maybe like 70 on the RSI, but also hitting an extreme from a deviation perspective, from a volatility perspective. So, maybe hitting the second or third deviation, that kind of stuff. I need both of them combined, and other elements, playing out as well. Or maybe there's a divergence, not in volatility, but a divergence in momentum, which kind of shows that there's less institutional participation. So, and that would actually be my kind of third point is like to see um, less institutional participation on that move. Definitely would highlight that I may need to be taking profit there, but you know, also from an economic perspective, if we're getting to a point where GDP is starting to, fall closer and closer to, you know, um, essentially hitting that, like maybe below average numbers, then, in that particular case, I would certainly start to think about, taking profits at that point as well. You know, so those are the things for me. What's up, Danielle? What's going on, Corey? Ayo. What's up, Terrence? Jose? What's going on, guys? What's up? And on the crypto front, I just keep a small allocation towards crypto, and I just kind of just keep holding it. I do agree with the volatility sentiment as far as like it being more volatile than the market in general. Um, and obviously, if you had to choose between trading shares of the market and trading, crypto, uh, crypto is going to be the more volatile choice. So it's going to be a better choice there. Um, but like we tend to trade options as well, Hong. And by the way, we do day trade sometimes, but we want the right environment to do it, right? Like today is a bad day to day trade. Unless you're like super scalping, and we're not doing, so we're not going to be trying to, scalp the market. That part we won't do. We're going to look more towards a clean day, that is likely to trend, really just a micro trend of the market. Then cool, we'll take that. But
So how you see the market is trying to decide where to go. You don't see clear direction at the moment.
right, exactly. Right. So yeah, I like to trade when the market's clear, like when it, like, and you can see those signs early on in the day. You can see those signs early on in the day, and if I don't see those signs, then I don't want anything to do with it. But you were right, though. We are certainly more swing traders, position traders here. That's what we do more than anything, and the day trading is more so, because it's a learning environment as well. So for those that want to learn how to day trade, that's more of the reason why I would day trade, is because I'm actually teaching people how. But I'm not going to teach them how to day trade in a bad environment, right? I'm only going to teach them how to day trade in the environments that are, conducive to growth, pretty much.
Yeah, like during the bear market, like if there's really nothing to do with day trade. Yeah, I think the direction has to be decided. That right now, yeah, it's like it's more than 50-50, but I also think that it's kind of going sideways at the moment. But I think if we likely decide where to go pretty soon, within a few months, and I think that's probably much safer for most people to jump in a little later than now.
Yeah, definitely. I mean, well, so we're going to be, if you're talking like medium to longer term, we're going to be holding those positions through that anyway, because so in different trend trading systems require different modes out of the market, right? So if you're trading like a traditional trend trading system, that and I'm just kind of moving my chart around here while I'm talking. So yeah, there we go. So if you're trading a traditional trend trading system that requires you to be seeing, higher highs and higher lows, or lower highs and lower lows, then like you said, it may take a few months for the market to get to the point where you want to be, like diving into that, right? But like, we trade trends based on economic factors and volatility. So this opens the door for us to, trade these different, more secular trends in the market. So for example, what we were talking about around the time when you came to the stage, is essentially, from an economic perspective, the trend has not shifted. From a volatility perspective, the trend has not shifted. If I was focused on market structure only, then that low that Ray pointed out back in November, it does something to the market. But that's why I feel like you need all three of those elements, right? You need market structure, volatility, and economics. You put those three together, your decision making machine is different. So here, I see the market structure shift, right? I see the market structure shifts. What I don't see, like I was telling Ray, is the volatility structure shift. So, there wasn't a violent move that followed through on that move to the downside, which showed less conviction. And then economically, nothing had changed actually, right? Literally nothing had changed economically. There was not one thing we can point to and say, oh, this has changed. So right then and there, from the perspective of how we trade the trend, right, we can actually get in at these lows of November. We can get in at these recent lows here in like mid-December here. We can take those positions, right? Because it's all about positioning ourselves and staying within the volatility range. So staying within the range of the market. So as long as the market does not break that range in the opposite direction, we can remain in that particular position, and just let the market consistently prove that it's it has a thirst for more upside, right? So that's the way I look at it, man. It's like just you know um, trend trading comes in multiple forms. That's basically what I'm saying. If you can spot economic trends, you can trade that all by itself without even ever looking at a chart. If you can spot trends in volatility, you can trade that all by itself. If you can spot trends in market structure, you can trade that all by itself. You know, um, but like I said, if you bring them all together, it's a really great system.
So, what other indicators do you look at? Give more emphasis. Like you mentioned about multiple things earlier, like unemployment indicator and Fed rate cut. What other things you look at it and you keep monitoring?
Yeah, okay. I like how you I like how that question closed out because I was going to make that distinction. So, there are things that I look at, and then there are things that I just kind of monitor. And so, when I say I'm monitoring them, that means that I'm just aware of what's going on with them, but I don't look at them all the time. Because most of these indicators, it's once a month, right? It's once a month, and once I know that, I'm not looking at it again, right? So PMIs is my number one economic indicator. So let's talk on the economic side first. PMIs are my number one. I don't think there's an economic indicator better than PMIs. Why? Because it covers the entire economy, right? Are you familiar with PMIs, Hung? The Purchasing Managers Index. You familiar with those?
Plain. What
Okay.
is that?
So the Purchasing Managers Index, what it does, right? And the beautiful thing is when I came to when I came to the markets and I started, operating in the markets, I had already experienced being on the purchasing manager side of the business. So I kind of resonated with it right out the gate. So what they do is they survey the individuals at the business who handle all the purchasing orders, right? So if you work for a construction site, it's that guy that's ordering all the bags of cements and so on and so forth, right? Whoever's in charge of making sure the business is stocked, okay? That's your purchasing manager. So if you're at a restaurant, the person that goes in the freezer and makes sure you have enough of everything, or the dry storage to make sure you have enough of everything, right? And then he goes out and he makes all those orders. If he's ordering heavily, right, then you know that he's preparing for a lot of good business, right? If he's not ordering heavily, then you know that he's preparing for less business. That's just kind of the index in a nutshell. But the purchasing manager tends to know about everything, Hong, and that's the beautiful part about it. They know if the business is going to be firing people in the upcoming months. They know if the business is going to be hiring people. They know if the business is going to be raising prices. They know if the business is going to be lowering prices, so on and so forth. So what the purchasing managers index does, the PMI, is it talks to purchasing managers in every single sector of the economy, right? And then it quantifies their responses in order to give us an understanding of whether the economy is expanding or contracting, whether or not we're experiencing greater demand or less demand, greater supply, less supply, so on and so forth. It even goes as far as to letting us know if exports are improving or imports are improving and those types of things. So it's a really great indicator, and it literally mimics the economy. Right? It mimics the economy, meaning it's weighted towards services, which are the largest part of the U.S. economy, or most economies. So it's weighted towards services, and then it puts more weight on the largest, parts of the economy. It can tell you whether the reading you're getting is synonymous with certain levels of GDP as well. So you kind of it's a leading indicator to economic production, pretty much. Right. So when the PMIs are doing well, you can expect the economy to be doing well. In the most recent PMI report, they told us that they were going to be producing heavy. So that tells me that GDP is likely to hold up over the next few months, right? And we should be fine in that regard, and we'll just wait for the next PMIs to come out to see if anything changes. Right now, in that regard, so PMIs, the employment index, um, which the employment index is done by the Conference Board. They give you an overall overview of the employment market, so I don't have to look at all these different ones, right? And the housing market index. So those three are going to make up my three top indicators that I would, look at on a regular basis. And then all the other ones are kind of, by choice, right? I choose to look at the CPI. I choose to look at the unemployment numbers and the jobs numbers. Right? I choose to look at those. That's by choice. But if I had to choose three that I'm going to look at all the time, it's going to be the three that I just mentioned: the PMIs, the employment index, and the housing market index. Um, as far as from like a technical perspective, we can talk about that after. What are your thoughts?
Yeah, so yeah, that's great. Sure. So so based on three that share unemployment rate and nearby and the housing market data. So like how do you see based on you've been tracking the data for a long time. So I want to know your opinion on whether the stock market is like you know like like if the stock market just keeps going up, but these indicators don't move, that means likely we are at the bubble and it might correct pretty soon. But if it goes together, likely there's nothing going on. It's not bubble. It's probably there's not going to be correction as well. Like, how do you see right now?
Yeah, right now I see them. Um, you know, so let's start with the PMIs. PMIs are stable and suggesting an expanding economy. So no bubble from that perspective. The employment index is a mixed bag, but let's just call it stable. So it's showing that more companies are choosing to um, take the actual route of getting rid of the worker. It shows that, but it also shows that they're replacing a lot of these workers in many cases. So we're still hiring. So there's this increase in unemployment, but then that gets followed up by and added jobs, in the longer run. So we'll see how that one plays out. But now, when you put those two together, right? When you put those two together, and you say, okay, well, I have stable PMIs that suggest the economy is expanding, but I have you know, a, a weakening slash stable employment index. Both of those together suggest that we'll have lower interest rates into a still strong economy overall, or an economy where we're still producing a lot, right? We'll put it like that. Now, I'm going to tell you this other thing, Hong, that we've been talking about recently, that they're also suggesting. The economy has been more productive. Suggests that we've had a rise in productivity, right? Because these companies are saying we're producing more, but the unemployment rate is saying we're producing more with less people employed. That's a productivity boom. So I'm just going to stick with those two alone, because the housing market index, I'm not going to use that as so I don't even use that for this. Right? For this, I can stick with PMIs and the employment market. I can stick with those two together. And so we have a productivity boom here. So we're doing more with less. So that's positive for the stock market. So that says to me that these companies may actually beat these earnings, and they may actually meet expectations because they're saving money. And I think you brought it up as well, right? They're saving money, right? But they're saving money not in a way that says that they're preparing for a recession, but in a way that says that, hey, we got rid of 1,000 people, and we got more out of our workforce. Right? So we saved some money in two ways. We saved money because we didn't have to pay these 1,000 people wages, and then we also saved money because we when those sales came in, they came in at a lower cost. I think in the end, though, so that's your medium term outlook. My medium term outlook is the market keeps going up. A longer term outlook is that those layoffs catch up with us. And so eventually the PMIs will roll over, and the PMIs will start to point to the downside eventually. And we'll start to see a market that responds to that.
Yeah, I think that's good news if the company need less people, but they are more productive. That means they have additional cash. They may do buyback, like what Apple does usually. They may buy their stocks, which means it's good for investors. So medium term, you mentioned, like, how long is your medium term? Like 6 months or 1 year?
Yes.
3 months?
6 to 12 months.
Oh, okay, I got it. Yes.
Yeah. 6 to 12 months. After that 12-month period, I start to think of that as more of the longer term.
Yeah, I'm actually on the same page. Until next year, June, I feel more bullish than bearish. But then, yeah, I have to see what's gonna happen after June. Yeah, I think we are totally on the same page. Yeah.
Yeah. So remember I told you earlier. So I have my VIX positions open, right? My VIX positions. So my VIX position is out until about May, so right around June. And I'll probably be rolling it over to June if we can break these highs. I'll probably roll that over to June. So yeah, we're looking around the same time. I want to see what happens between now and then. I'll say this, Hong. The January barometer, that I'm looking forward to as well. That's my year opening indicator. Want to just kind of see how the month of January goes, and sort of map that out and see if because this year it worked out perfectly because this year it said, hey, be cautious, and by April we were getting our butts kicked, and then now we're back here where we are. But it definitely was a helpful tool this year. It's a helpful tool every year actually, but this year for certain it helped out a lot.
So it's another question. How would you catch the bubble? Like, right? Like, I mean, like, how do you sell your position? So you are expecting. I mean, it looks like the market is going to decide, and then like there seems to be less certainty. Like even like beginners are jumping into the market. Like, how would you sell? Like how would you sell like everything at once, or like 20% every month? Like, what's your strategy in exiting?
Excellent question. So I would say I kind of go in stages. Well, not kind of. I go in stages. All right. So stage one for me is actually confirming that I'm seeing what I'm seeing, right? Before making any decisions. And so, because what's going to bring an end to the bubble? That's the question. So, first, like to start off, if I'm looking at the market, right, and I'm seeing what we saw in 2021, then a rise in interest rates is going to bring an end to the bubble. Right? We knew that, and we prepared for that differently. So in that moment, I'm taking. So I start off with stage two is to start to manage your assets. So I would say in that environment, if interest rates is going to bring an end to the bubble, it's going to snap the win streak that we're currently on. Then the first thing I want to do is I want to sell my bonds before everybody else starts selling that, right? And I'd probably usually sell maybe 80% of my bonds if I think the market's going to start to, and that's probably the minimum. I might even sell all of them. It depends, right? In that environment, 2020, 2021 going into 2022, I sold probably like 90% of my bonds, just literally got rid of them. Anything that was yielding less than 5%, I just got rid of it. Right now, then from the stock side, I'm not doing much there. Right, I'm just going to take my profits, and then we'll talk about what I do after that. First, I'm going to take my profit there. On the crypto side, that's probably the one thing where it's gone, right? Like I'm cashing out of crypto totally because whatever happens, it's gonna respond beyond what the market's gonna do. So if the market drops 10%, crypto is probably gonna drop 20. If the market drops 20%, crypto is probably gonna drop 40, and you get the point, right? So if you go back to 2022, you can see how that played out. Now, once I do that stuff there, then I can start to focus on pretty much flattening my portfolio, reducing the impact. So in that kind of environment, what I do is, I find out who's likely to move along with the market to the downside who's likely to give up without a fight, pretty much. So usually, Cisco's my first victim. Cisco usually gives up without a fight. They're not gonna, Cisco's not gonna fight this downside. The market goes down, Cisco's going down, right? I've never seen a tremendous drop in the market where Cisco didn't acquiesce, right? Roll with it. So I usually start with something like that, figuring out what are the weak names I want to get rid of, if any, right? So if there are some stocks that I'm holding that I currently don't believe that they're the right ones, I'm going to replace them with the stronger stocks. So I'm not going to sell them and leave the cash. I'm going to literally sell out and get rid of those and buy stronger names that can withstand some downside. Now, I'm also going to take long volatility positions. So, I'm going to do the math actually. So I'm not just going to buy, positions. I'm going to do the math. I'm going to say, okay, cool. If I expect this much downside in my portfolio, how much volatility do I need to hold in order to neutralize that downside? So most of the time when the market drops 10 to 20%, I'm either down single digits or I'm actually making money when the market drops, right? And there's been many times where the market's dropped 20% and I was able to come out with a profit instead of seeing my portfolio at a loss. Because I do the math specifically to make sure that I have just enough volatility built into my portfolio, right? So I'll do that instead of selling all my stocks. Now, on the downside, I will start to peel some of those things off, and that I think that's where I can sometimes end up slightly negative instead of positive, is because maybe I might peel some off too early, I mean, can't do everything perfectly, right? So, but if I can limit that downside in this particular way, it's gonna work out for me, Now, if we're dealing with a bubble that's just popping because of a lack of conviction and growth, then I actually want my bonds. I'm actually gonna stack up on bonds, right? Because if a rising interest rate is not bringing the end to the bubble, then
Just 1 second.
yes.
When you say bond, what type of bonds are you talking about? Is it the government treasury or the bonds from corporations?
All types, right? So usually what I do, and I'm using ETFs, by the way, because I don't want to go through the whole process of just buying those directly. So I'm just going to use bonds, bond ETFs. I lean towards senior notes for much of it, government bonds, and I'm going to have a little bit of high yield junk, right? But a well managed junk portfolio, more than anything. So I'm actually going to buy more bonds if I think it's going to be growth that causes the problem. I'm going to buy more bonds. So that's going to be my first step, is pile into the bonds. Why? Because interest rates are going to drop, right? So I want to lock in those high yields ahead of time. And then number two, when those yields drop, the value of all the bonds is going to spike. So I'm going to get, yet again, in an environment where when the market's coming down, here I am again getting appreciation out of something else. All right. So that's going to limit my downside of my portfolio there. That's number one. Same deal. I'm going to take profits. I'm going to lock those in. again, because remember, my step number one is to make sure I'm seeing what I'm seeing. Right. I want to make sure I'm not making the bad decision here of, going the route of preparing for this bubble to pop and for things to start, falling dramatically. So in that regard, then yes, I'm going to start taking my profits there. And, back then we didn't actually have the ability to go long the VIX back then. We do now. Hey, now we can go long the VIX. So now I would load up on the VIX. Right. And again, do the math, right? If the VIX hits, 50, what does that look like? If the VIX hits 60, what does that look like? Right. But mainly I prepare for the VIX to hit 30 to 35. Right. And so that means probably going to get a lot of.
Just one.
Yeah, talk to
Buying these is just really so that what I'm worried about is that buying these at the wrong time can hurt.
Yes, sir.
And because you have to allocate some position to fees, which means you have to sell some of your positions, and that goes to VIX. If nothing happens, you are just losing opportunity or losing money on VIX. So how do you deal with it?
Yeah. So great question. By the way, and I forgot to mention one thing that I did back then that I would do it now as well. And actually, I have it more of a perpetual stance now, which is turn my dividend drips off. No reinvestment during the popping of a bubble, right? I want all that coming to me in cash. I forgot that part. All right, so that's why I stack up some extra cash. In this particular time, I'm doing the same thing now. So a lot of that dividend cash that's coming in is going to make up for some of the losses in the VIX there. So we'll be clear about that. My bonds, right? Remember that the bounce in the bonds is going to make up for some of the loss in the VIX there as well. But the key thing is to buy the VIX at the right time, right? So I'm not going to buy the VIX when it all already started. Right? I'm going to buy the VIX when people, remember what you said earlier? I do the same thing. When people are their most optimistic, that's when I'm going to buy the VIX. When people feel really good, right? So my cost for the VIX is going to be really low. I go out in time. So I'm always at least 6 months out. So that limits the time decay of those options on the VIX. And so then my plan and my goal here is that if I'm wrong, I've already made the calculations that to the point where all I did was limit my upside in my portfolio. You see? So put it like this. So let's say I'm currently losing, $200 this month on VIX, right? And I was supposed to make, let's say, $800 this month in stocks. Well, then all I did was limit my upside to 600 in the stocks. So that's how I really put it. But the market falls, the VIX rises far more than those stocks fall. So it's a limiting of the upside potential of my portfolio, but a maximizing of the downside potential of my portfolio. That's how I look at it, right? Of the downside, like of my gaining potential to the downside. So that's how I really set myself up. So I can still make money if the market rises, but if it falls, I have this this window of opportunity there to make more money in that regard. So, that's how I deal with it, is by making sure that I'm still offset to the upside. Because how we verbalize that, how we express that is we're still bullish in the short term, right? Bearish in the long term. So I have to leave room to continue to make money to the upside in the short term and make sure that I don't overdo that. All right. And one of the ways I can do that as well is having maybe while I'm 6 months out on the VIX, maybe be 90 days out on the market itself with a smaller position that just, continues to offset that VIX a little bit more. So I choose how much the market can actually get from me if I'm wrong about the bubble popping, pretty much.
Right, I like the idea of buying VIX. It's safe. I think there's less chance to lose a lot or chance to win big. I like that idea. But what if that you are wrong, that for more than 6 months, the correction is not coming, the market is not popping, but the market actually like aggressively going up. Like this trend doesn't seem to be ending. Like so basically you are missing out entire this rocket shooting like I don't know, it will eventually correct, but somehow like you missed that like for many months, like 4 to 6 months.
Yeah, I know what you mean. So, okay. So first thing I want you to do is remember. So, I keep myself offset in the short term. So only a massive drop in the market can break that offsetting position. Meaning, only a massive drop in the market can make it so that way I'm actually losing money in the short term on my stock positions. Right. So imagine, like I said, let's say I have this position in the VIX. It's 6 months out. So, but let's say the market still goes up for another 5%, right? Like you said, first of all, the downside is limited because there's only but so much. How the VIX is. Like it only goes but so low, right? So that's why the VIX is a really great thing to have there because when it drops, it's gonna have a floor beneath it, right? Because there's only but so optimistic the market will become. So limits that downside there. The other thing is I never let the market get within 90 days of my VIX position. Never. Right? So if the market was to get within 90 days of my VIX position, I'm going to roll that position outward. All right. And typically, the cost of rolling that out is where I'm going to see the realized losses. If that makes sense, right? So what I mean by that is that's usually the only time I will see a loss on the VIX is either when I roll it or when I finally close it out. If I decide that okay, the risk is gone, whatever risk I saw, if it's gone and I close it out, then those losses right there I'll see. Right? Like recently, for example, we closed out some VIX positions for like early next year, but we kept the ones for, like I said, between May and June, right? So use that as an example. When we closed those out, we were pretty much at break even, and we had held those hung for months. We were still at break even pretty much when we closed them out because we got them at such a great point. Like these are the moments here where we buy the VIX. We're not going to buy the VIX when it's already at 16, 17, 18. We're going to buy the VIX when it's at 13, 12. We're going to buy the VIX down there. We can roll it when it's at 13, 14, 15, so on and so forth. But when we first enter that position, it's going to be at the lower level. Right. And so now if the market was to move higher by 5%, whatever the market gives you is what I'm willing to give to the VIX. Right. So let's say the market moves higher by 5%, and that made me, like I said, let's say it made me $5,000. Well, then that's $5,000 right there that I'm using to mitigate whatever's happening with the VIX, which usually won't be anywhere near that $5,000. Maybe 10% of that is offset by the VIX. Maybe 30% of that is offset by the VIX, but it will never be all of it. So we're still going to make money. You have to remember that part. Like when I think about positioning, Hong, I don't think about the single position I'm in. I think about the totality, like the total positioning that I have. Right? Because the VIX is not a position all on its own. It's a part of this entire portfolio. And so I don't look at the VIX and say, oh, well, my VIX is down. I look at my portfolio and it's my portfolio down, then that means I'm doing something wrong. My portfolio can still be up in those moments. I know I'm doing everything right. Hopefully that makes sense.
Yeah, that makes perfect sense. Yeah. Thanks for the information, by the way. It's I mean, like, it's rare to find room like this in Clubhouse, by the way. Sincerely talking about the market. Yeah.
Appreciate it, man. Much appreciated. Ray, you gonna say something?
When you mentioned you hedge, like, if you're going to hedge like a whole portfolio, so, without obviously getting into specific numbers, are you speaking about like a traditional sort of delta hedge where you take, the value of a portfolio you want to hedge and you would use a certain delta with it, like say like a put, and you would, hedge that way, right? So as the market comes down, your whole portfolio is coming down, but this put over here is sort of hedged accordingly. So it's sort of buoying your overall portfolio. Is that what you mean?
Yes, sir. That's how I work, right? Because in the end, Ray, right? What I look at is that number at the top. I'm not looking position to position to position to position unless I'm dealing with my my actual stock portfolio, right? In that regard, like I'm not going to let one position, just take money from me consistently, right? But when I'm talking about the entire portfolio and how it relates to the options that I'm trading, so typically if I'm trading an option to the upside, I'm doing that because I want to, essentially enhance the gains of my portfolio, right? So let's say the market's going to be up 5% this month. I'm choosing this as an example, right? Then I want to open up a position here that would turn that 5% into maybe 7%, 8%. All right. Not overdoing it. You see what I'm saying? Don't want to overdo it. But if we can just kind of nudge this thing along, then when the market wants to come down, I want to open up a position that's going to take that 5% down and turn it into, 2%, 3% down. Or, like I said, if I position myself well enough, it turns it into a gain. Maybe I'm up 1%, maybe I'm up 2% instead. Right? So that's how I look at it, man. Like I look at my portfolio and what's happening with the whole entire portfolio. Right. And so and what I like to do, this goes, for both of you guys for the questions you asked, what I like to do is I like to kind of feel the market out a little bit, right? So I always tell these guys, matter of fact, let me see here. Alicia, what's the first thing you do when you open a position? Let me see if you remember. My eyes are closed. Hold on. What's the first?
Learn.
Oh, check you out. Cooking. Yes, ma'am. Right. The first thing we do when we open a position is learn. Right. So basically what we mean by that is, okay, cool. I added my VIX position, right? Okay. Let's say the market drops maybe 1% that day, right? Right? Drops maybe 1% that day. That 1% the market dropped, I can then see how well the VIX was helping me to hold on to those. So maybe the market dropped 1% and my portfolio dropped, I don't know, 0.5%. Might be happy with that. You know what? Okay, cool. I'm good. I'm gonna leave that alone because I know if the market dropped 10%, by the time the market dropped 10%, the VIX is holding me up. All right. If it cut half of my losses on the first day, right? On the first 1%, then I know by the time it gets down 5 to 10%, I'm already, you see what I'm saying? I know by that point, I'm definitely already, like seeing what I need to see. I know that it's already, pushed me back into the green by that point. So, I'm always looking like, so, I just kind of tweak the positions a little bit, do the math. Okay, I think I need about this much. Let's put that over there. Okay, cool. And I look and see now maybe I realize I have too much. And I say, oh yeah, we need to peel some of this off the table. Let's get that out of there. Right? It's a little it's padding my portfolio a little too much. Right? And that's what you realize in these moments. It's like, you know, um, the market will reward you well for taking great risk, right? It won't reward you enough for taking too little of a risk. You got to find that sweet spot, in between. You don't want to be on the extreme side of that in either direction.
So yeah, that's a very good insight. You should not go other extreme side. So there's a chance to make a lot, but also there's a chance to lose a lot. Um, so like you also mentioned about the entire portfolio that you're not really going, one direction, everything and everything also goes another direction. You don't do that. You manage the entire portfolio. So like what's your portfolio looks like?
Yeah. So I keep at the moment I'm 70% stocks and bonds, with 70% of that number in stocks, right? 30% in bonds. I have about 10% in crypto. I'm sorry, 10% in REITs, about 5% in crypto. And then, I'm just from there, like right now, I think I have about 5% hedging to the downside right now. That's pretty much it, and then the rest is just in cash, and I'm letting the dividends hit the market, hit the account. That's where I'm at right now. And I'm just kind of keeping that balance at the moment.
Yeah. So by June, let's say that kind of see the market like going up way too much. Everyone is excited that you feel like you have to sell. Then you mentioned about VIX. Then like currently your allocation to VIX is 5%. Like how much will you have when you expect the correction coming?
It might
5% to.
Go ahead.
I mean, how high will you go up? Like with VIX currently 5% because you don't expect any like major correction. But when you expect major correction,
Yeah. So it might stay 5%, but I may add on an actual short to the market, for example, right? I may say, hey, look, now I can actually, because right now it's that safety net for the just in case, because we're still in a risky environment nonetheless, right? Like we said, about that 30% potential for downside. So right now I might sit around 5% then, but in the future, I may be willing to actually short the market because now I see this more clearly that this downside is coming. So I may keep the 5% VIX, but then I may add actual shorts to the market. All right. So I may go short the Nasdaq, short the SP 500, short the Russell 2000. What a few weak names, like I said, short Cisco because they'll and Cisco is very cheap to short, so that makes it easy. I can get a 1-to-1 on Cisco. I'll probably do like 60-to-1 or 70-to-1, but you get the point. Like that. That's how inexpensive it is to short Cisco in that moment. Implied volatility is going to be at its on the low end in that moment. So yeah, that's how I look at it. It's like long volatility until you feel like you can go short the market. That's how I look at it. So the long volatility is like a placeholder.
Yeah. I have a question on this. Ever like the market moves like how it moved 2000 the Trump bubble, that some people felt that the market was moving up way too high, and they start buying short, and then later on they realized that the market just kept going up and up and up and up, like without any stop. If ever that happens, like how would you manage your portfolio? Because your short position will be bleeding, right?
No, it wouldn't, because I would exit it. I'd be gone out of short position. So, how I usually handle it, right, is let's say I take the short position. Like I said, let's say I'm feeling confident, right, that this is downside coming. I'm usually watching certain other indicators, so don't forget that part. So that means I'm probably watching for something to happen. If that thing does not happen, and I see the market start to explode in the opposite direction, I will get rid of those shorts. Again, I can keep the long VIX. Those shorts got to go. See what I'm saying? All right, I'll probably cut the shorts off at maybe like minus 20% or so, something like that. And so let's say I had 10% of my portfolio there, for example. Then 10% by 20% means I lost 2% on that trade. And that's why I like to be mathematical with it, because you can understand it, right? So, I'll probably come off at 20, maybe 30% probably, So maybe I lose 3% of my portfolio betting that the market was going to fall, and it didn't. That's all they're probably going to get from me. I always keep a secondary, what I call a secondary stop. And that secondary stop is usually a percentage, right? As opposed to a price in the market. This keeps me from overdoing my assumptions, and it keeps me from, allowing my ego to take over and just continue to hold on to losers when the market is clearly showing us something other than that. So yeah, I'll probably close out those shorts at around minus 30%, but the VIX I can probably let that be the last man standing. I probably get rid of it eventually, but I would have gotten into the VIX at such a good price that it wouldn't really matter that much in the moment. Everything else would be bleeding, but the VIX probably would be pretty stable.
So I remember 2019 when Tesla stock tanked, that I watched many YouTube videos that saying that Tesla is gonna go bankrupt, and this EV market just cannot sustain. And what happened was that it started bouncing and kept going up and up and up and up, and it actually hit from that low all the way up. It was more than 40x, and along the way, many people bought short, and they lost a lot of money. And they kept adding their shorts because they were thinking like, this is crazy, like this can't happen. So I don't know. I'm really afraid to have shorts in my position. But the idea of VIX, I think that's brilliant. Um, but yeah, I tried buying short, but never it was good for me. Like, so I only buy one direction, which is long, and I don't know. It's the timing, the market, especially like how high the market is. That's I feel like that's 5 times more difficult than timing the bottom. For me, timing the bottom has been much easier than timing the top. You mentioned about when the Fed decide to increase the rate, that usually pops the bubble. That was the case 2022, but I don't know if that was always the case because like before the Fed decides to increase the rate, the bubble can pop, right? And so I don't know what indicators are you relying on to time the top. Like it's been very difficult for me to time the top.
Yeah, definitely. So I want to point this out, right? If you notice, if you notice one thing, right? My short positions that I mentioned were usually shorting the market and not a single stock. I think when those individuals tried to short Tesla, it was just a bad idea, especially when it had that momentum to it. And the way the market is nowadays, Hung, is that you wherever the momentum is going, that's where the money goes. Until we get to the point where there's not enough people on the other side to help us, fuel that. But um, so I'm a valuations guy, right? When it comes down to timing the popping of bubbles, right? So 2022, before the Fed even, started talking about the interest rates. So back in 2021, we already started talking about the price we were paying. So I use a method known as present value of growth opportunities, or P as in Paul, V as in victory, G as in go-go, O as in Oscar, right? PVGO. So that's my usual valuation method. And so what it does is it tells us how much we're paying for growth. So if I look at the S&P 500, what amount of that price am I paying for growth right now? And so you have these like longer term averages and things of that nature. So what I look at is when we start to approach more of that 2 times no growth scenario. Now, this doesn't mean that the bubble is going to pop immediately, but it's a great indicator that the market may be overdoing things. So I'm actually going to bring up my let me pull this up real quick. Hold on. So I'm going to open this up. Mm, you know what? I did not. So right now, the current no growth value of the S&P is about mm, on the more conservative side. On the more conservative side, it's about 34.17. You know, on the more aggressive side, it's about 36.38. Right. So in this regard, if I take 36.38, and I'm just gonna, keep it simple. So 36.38, divide that by about 0.65 here. So just about 5,600 is probably the best place to buy right now. Obviously, we're not near that right now, but I'm just saying, if it hit that number, I would buy the market no matter what was going on. Okay. Now, but 36.38 times 2. If the market was to hit 7,276, we would certainly be in a bubble, right? I would have no doubt in my like no doubt in my mind at all that would be a market that I would want to start positioning for downside. Right? I did a study once, and I actually I did a study and showed it live, where we took the market each year and did a 2 times no growth value for each year. You have to use you have to use the next year's projected earnings for this year, and then you map that out. You overlay that, and then you realize when we hit that mark, that was usually the end. It was usually over with by that time. So that's one of my indicators. There is when we are just trading too close to the top bull case, because it's one thing to be 2 times no growth for something like and let me explain no growth value. So no growth value is essentially what a stock is worth if we didn't expect any growth at all. All right. Then you have the same thing with a stock market. What is the stock market worth if we expected no growth at all? All right. And so when you hit 2 times no growth, then what we're saying is the stock market itself is going to grow earnings by 15% per year for the next 5 years on average. All right. Or better. So we know that that's an unrealistic scenario, right? That the stock market is going to double its earnings every 5 years. Something usually happens. Right? And so by the time we hit this point, we're usually too exuberant about the market. And so we did an overlay. We overlaid it for I think we did 10 years overlaying it. And in each of those 10 years, when you hit close to that 2x mark, that was it. It was over with. When you start closer to 1.5 and work your way up from there, in those moments, the market was more likely to keep going higher at the beginning of the year. All right. So these are some little things there. So when you started anywhere between 1.5 to no growth, the market was more likely to go up that year than to come down. So so that's one of my main indicators, man. So that's not an indicator. That's not something that the market's doing and I'm just following it. This is something that I do for myself. I track the earnings of the S&P 500, and I do the math for myself. What is the market worth? All right, and then we just go from there. So I'm not gonna lie. That means that if we broke out of this range right now, and we did hit some and we did break to the upside, by the time we hit about 7,200 on the S&P, all right, maybe 7,300, where we will be in trouble. So I'm willing to bet on that further upside. All right, as you can see, I'm long the market right now. So I'm willing to bet on that further upside, but from there, from there, we'll just have to wait and see, how good does it actually get? Another thing that, because bubbles look different, huh? Right? If we're at high valuations and financials and energy are outperforming, this happened in 2022, then likely a bubble about to pop as well, right? And I'm not saying that it's always the Fed to break the case for further upside. But those are the moments where the Fed has to step in and pop the bubble for us. They have no choice. Otherwise, you're gonna get hyperinflation, right? So they don't want that. So yeah, but my biggest indicator though is the valuations. I go with valuations every time.
Yeah, that's good. Just in case that you miss out the tail of the bull is like sometimes really long, like unexpectedly long. It should pop, but it doesn't. Like, how would you manage that? Will you be just okay missing out, or will you be chasing? What's your strategy?
Yeah, that's a good question. So my strategy goes back to that bullish in the short term, bearish in the long term narrative. It goes back to that. So that becomes my strategy. And so I usually don't end up missing out because essentially what I'm gonna do is when we get to the point where I feel like a bubble is forming, what I'm gonna do is I'm gonna stop buying stocks. That much I'm gonna do. Right? I'm not buying stocks up here. Right? So let's say we break 7,000. I'm not buying any stocks. I'm not doing it. Right? I'm gonna hold off on buying. But I will go long an option, right, and supplement those gains. But the option is going to be more like over the 90-day period. And then I'm going to focus more longer term, 6 months to 9 months, maybe even 12 months to the downside. So what I do is I use that downside position as pretty much a license. Right? I use it as a license pretty much. So when we get to those points where the market is just continuing to explode, even when it shouldn't be, okay, cool, no problem. That's where I may position myself in the VIX. So no matter what happens, if the market just decides to drop dramatically out of the blue, I'm covered. And now I have the license, I have the right to trade to the upside now. And to give that greater context, right? So let's say I owned an option, right? Let's say I didn't own the stock at all, but I had the option for the stock. Right. So let's say Apple stock, and I didn't own any shares, but I had the stock. I had the option. Now, usually, I need to own 100 shares to sell an option. But what a lot of people don't realize is owning the option gives you the right to 100 shares. Right. So in this particular case, it's like saying by being long, I have the right to be short. By being short, I have the right to be long. So instead of just sitting out the rally or just chasing the gains, what I do is I give myself the right to go long by holding a position that would benefit if I'm wrong. So if I'm wrong about the market being bullish in the short term, I have a safety net beneath me. So you can see a lot of my strategies, what I do is I focus on my positioning more than my will to win, right? Or my need to be right. I don't have a need to be right. Right? And I don't think anybody should focus on that in the long run. Like, was I right or was I wrong? But I can still talk about it from a perspective of being right or wrong, right? So like, if I'm wrong about it, if I am wrong, you know, I still did the right thing, right? So that's all it is for me. If I take a position, it was the right position to take. And other than that, I don't really think about anything else. You just limit your losses and carry on from there.
Yeah, so it sounds like overall you really care about keeping the entire portfolio. So in that case, my assumption is that you might be beating S&P 500 sometimes a little bit more, but when you lose, you probably lose, I don't know, less than S&P 500. Like,
Yes,
is
sir.
that or that's how it's been happening?
Yes, sir. That's it.
How did it? Okay.
That's it. Because typically when I lose, that means the S&P is losing. I think you gathered that part, right? If I'm losing, the S&P is. And I usually make it so that way, if the S&P is losing, I'm losing less than they are. And if they're winning, I'm winning more than they are. And that's usually my setup. Yeah, you're on point. Oh, by the way, but there are going to be some days when I'm doing worse than the S&P, but it's not going to be the majority of the days. The majority of the days I'm going to do better than them. But then, there's always an offset. Everyone has to know that, right? Like, every day will not have the same outcome. All right. But what I know is those days when I'm not doing as well as the S&P, those were the days that had to happen. Because, when it's all said and done, it's like saying, it's like the turtle and the tortoise and the hare, for example. At some point, what you're doing becomes exhausted and it needs a reset. And so those are the moments when I know, okay, all right, cool, all right, I need to reset here. So there's something that needs to happen. Whenever I see that happen, I know that I need to fix something. Something's off, and then I can go in and I can say, okay, there it is. I need to get rid of this guy right here. See you later. Boom. Move that out of the way, and then all of a sudden I'm back to outperforming the S&P every day, and and I can just keep going like that.
Yeah, that's great. So my question now is when just in case next month, like out of nowhere, there's breaking news that causes market cracks like crazy. Like you expected from the first day of large drop. What will you do? Like, will you sell some of the positions, or you just hold it? You just watch, and you just do nothing. Like, well, what's your strategy on just in case of sudden drop next month?
Yeah. So for next month, if that happens, I'd probably be looking like right out the gate to see, if anything is shifting the bias to the downside from a volatility perspective. If that's the case, then those are the moments where I said short to medium term trades work. So probably take a short term trade, but in the medium to long term, I'm not doing anything because I'm already positioned for that if that happens, right? And then I can just kind of supplement that VIX position with with a little short here, a little short there, and now what I'm really watching is I'm watching the floor, right? That floor that I believe is there, I'm watching that right now. All right, I need to see if that breaks. Because if it doesn't, then I'm actually going to end up buying Hong. If that floor that I perceive to be there does not break, I'm buying the market. So I'm going to take a little short term trade to the downside, I'm going to watch for the market to hit the key levels down there that I already have mapped out. And yeah, because remember, whatever shock comes in to bring the market down, if it doesn't change the long-term outlook for the economy, then it's a short-term. Right? It was a short-term risk with no feedback. Right, so it doesn't take us into a loop. Right? I look for the things that take us into loops. And if it doesn't, then yeah, I'll just end up buying the market. And that'll be short to medium term as well. It won't be a long term buy. It'll just be something to get me through January.
Uh, you know, like what had been 2022 basically fed the bubble before it popped by itself. And do you think that's now the strategy of the Fed, that if ever they detect any type of bubble, they are gonna pop it before ever it's growing even bigger? And so meaning that there's not gonna be correction like or bubble like a 2000.com bubble ever again.
No, I don't think that's their plan. I think they really just they popped the bubble. That was their intention, wasn't to pop the bubble. Their intention in 2022 was to avoid hyperinflation. We just happened to be in the midst of a bubble at that time. So that's all that really was. Because like right now, if that was the case, then they should stop lowering interest rates right now, because we're certainly in bubble territory. I can't necessarily say it's a bubble yet, like I said, because we have no proof that we have no proof that Nvidia and these other companies will not deliver. We have no proof. So I think it becomes a bubble if we overpay for it, and there's also no proof that we're overpaying for the biggest names. Right? Like, so when I look at here, let me go through some of these names, right? Matter of fact, I'm just going to pull up NVIDIA and just keep it simple, just use NVIDIA as an example. All right. And who do I have here? I have United Health. Okay, gotcha. All right. Let's pull up NVIDIA. All right. So right now, we're expecting a 48.5% growth, compound annual growth rate out of NVIDIA for the next 5 years. Now, I'm going to be honest with you. Do I believe that's going to happen? Heck no. I don't believe that's going to happen. But that's the projection. And the reality is that we are only paying for 31% growth right now. That's what we're paying for, 31%. All right. So you just gotta think of it from that perspective, if we were doing a little bit better, with handling things, as far as like valuations, it wouldn't be so how do I put it? We tend to move very quickly. The price earnings growth on Nvidia is a 0.5. So again, like, this tells me that Nvidia could double in price right now, and that's crazy. It's crazy to think so, and we only believe that because of the growth expectations. Can you imagine a $9 trillion company, huh? It's craziness, right? But it could happen. It could happen. So those are the things that I would say, let me know that the Fed is not caring about a bubble. because they're allowing for an environment where we actually can believe that a company is going to grow earnings by 48.5%. The same thing happened with Tesla in 2022. They were supposed to grow their earnings by 50%. That didn't happen either. All right, so just want to point that out.
Yeah, that's good insight. Thank you for sharing that. Yeah. So I certainly think that that is possible, that the Nvidia becoming, $6 trillion company. That's a possibility. Yes. Well, why not? And there will be then a crazy bull market. It could last maybe even until end of 2026, and then I don't know what's gonna happen. We cannot really predict like 1 year long market move.
Yeah, man, it's rough. It's rough. Like so those kind of expectations in the market, I just roll with them in the short term, but I start to prepare and bet against them in the long term. Is kind of what I'm getting at. I'm like, okay, cool. So I just need the market. So I'll give you an example, right? Let me go over here. Let me go to bar chart. Let's pull up SPX, SP500. Oh, look at that. Lowest volatility. We hit it, Ray. We hit 0% on SPX.
Too much lower than that.
Right, we had 0%, man. There it is. And by the way, like that's like it starts off as a bullish signal, Because essentially that's like saying, the VIX is low, so it kind of boosts the market a little bit. But now check this out. So 7104, 7100. We were just talking about this, right? Here it is, 7104. That's where we're going to hit 70 on the RSI at. So if we hit 7100, Hung, what I'm saying is, yeah, I'm going to bet on the market going up right now. But if we hit 7100 on the S&P, at that moment right there, I'm gonna start taking my profits, moving them to the side, and I'm gonna start to position even heavier, in the VIX until I can see something else playing out. So that's where I'll probably buy some June VIX, some July VIX, right? And now I'm probably gonna have a ladder. I usually use a ladder, and in these types of moments, I use a ladder. Yeah. And we'll take it. We want to go to 7100, go to 7100. And I'll be waiting to take my profit from there.
Looking at the chat, I gotta get running to some other stuff. I guess stuff this afternoon, but I'll be around if I don't jump in or see anybody. Happy holidays, Merry Christmas, and as always, appreciate the chat today. Good luck with everything, everybody.
Definitely, man. We later on tonight we're doing a session, Ray. I don't know if you're gonna pop in or not. But invest for 2026, new stocks for the new year. I'm gonna be coming with some investments that I think, could play out over the next 12 months. So, chime on in if you can, man. Chime on in if you can.
Yeah, I should be around. I love to see it. Sounds like a good topic. It's something I'm thinking about myself for coming here. So we'll see you later then.
All right, yeah, definitely. And we actually are about to close out in about 6 minutes. You know me, I close out around noon.
Sounds good. I'll see you guys later. Thanks again.
All right, man. Great convo today. So Hong, I know you said you kind of have your difficulties, like finding those moments to go. By the way, I agree with you. It's so much easier to pick a bottom in the market. It is 10 times easier to pick a bottom in the market, just for the record. That's actually my favorite. My favorite trade is, you know, trading around those lows. Because it's just so easy to do it. Especially when you have the VIX in your favor. Because the VIX just won't stay elevated for a long period of time, right? So short volatility along the market in those moments, you know. But yeah, man, we have a lot of things that we practice and we learn about and whatnot. So I guess this whole holiday break is coming up and whatnot. But we'll be right back at it. You know, and definitely hope to see you more, man. This is a good conversation, and you asked some really great questions today that I think help people out. And that's the beautiful thing, man. Like when you have a truly inquisitive mind around, and they're asking all the right questions, people benefit from it. So this was a refreshing break from the normal today. Do appreciate it.
Yeah, I appreciate it too. And I have more knowledge in crypto than the stock market. So I got into crypto 2014, right after crash, and then that's where I got in crypto, and then crypto ride was really amazing. Like I never expected this could be like this big, this market, like Bitcoin, like around like 100,000 is like something that I never expected, you know. But yeah, I started diversifying after 2018. So I trade precious metal as well, gold and silver. And then, my main trade is crypto. And that is, but yeah, crypto, gold, silver, everything gets heavily affected by the U.S. market. And that's the reason why I have to, somehow be more cautious when trading, because when the U.S. market, start dropping, like it affects everything. So I also have some, ETFs. Probably like about 25% of my portfolio is in U.S. market, and about 10% is Korean market, and 30%, over 30% is precious metal. And it's been really good, especially this year for the silver and gold. I expect them to go up even more. So yeah, it's been a great year. This year and last year was really good, and I hope just one more year, 2026, the market keeps going up, and I'm okay to see bear market, like 1 year bear market after 2026. I'm already satisfied with the profits. Yeah.
Yeah, definitely, man. If 2026 pans out to be a good year, man, I don't know how I'm gonna feel about it, Hung. To be honest with you, because in some ways, I think I'm gonna look at that and say, you know, the not that the system failed, but that um, the system itself more so didn't. How do I put it? The system itself more so didn't, you know, lean towards a sense of normalcy, and because I think more about people as a whole when I think about what I want to see out of the market. You know, because I'm gonna be pretty much fine no matter what. But some people, they're not ready for the market to take that next leg up. They won't know how to respond to that, how to react to that, and they'll keep buying and buying and buying. And there's no telling how serious that leg to the downside is going to be when it actually comes to fruition. I mean, um, you have some people that bought at the top end of 2021. Um, and if you go back to April of this year, everything you bought at the top end of 2021, it was nothing, you know. But like for us, the guys that you see here, the top of 2021, we were already planning to buy at the bottom of 2022. So it looks different when people are planning and they're more prepared for things. And so, I don't know. I don't know how I'd feel about another year to the upside, man, because people just got done going through, you know, um, through the worst types of conditions. Um, and now economically, even though the market's doing well, they're going through the worst conditions economically now. So, if the stock market keeps rising, this is going to continue to extend the upside in GDP, which again does how well does that work for everybody, right? For some people, the more spending that keeps happening, the worse things get for them, because it's driving prices higher, and it's just it's just forcing this new regime, of shrinkflation and all these different I don't know about you guys, but you know let's say
I kind of see what you see, and
yeah.
that's really true. That overall, the purchasing power is getting weaker, right? So people are struggling even more. So that's why we see the low birth rate. People stay home. People don't go out because they have to spend more. And that's what's happening all around the world. And so, since there's entertainment, which is a lot of entertainment coming from the phone. So people are like basically spending a whole day with the phone. That's like socially like some worrisome. But it's really bad that the humanity hasn't ever truly appreciating the labor, and we see that the unemployment rate is going up. The Fed is printing more money. What that does is actually devaluing the cost of labor, and meanwhile appreciating assets even more. So this wealth gap will only grow between haves and those who have assets and those who don't have assets. And I think the only thing that we can do is we have to well position ourselves to be the side where we grow our assets rather than selling our labor. Like so yeah, like I mean, in the media and then socially speaking, that it seems that people care about the effort and labor, but in fact, society has never been fair with the labor. The labor has always been depreciating asset, and so if we go back in time when boomers were in their 20s and 30s, they were able to buy house easily, and they can also raise two and more kids. And just one person working, the father working, and the mother didn't need to even be a worker. But today, the couple have to work, and still they are not able to buy the house. They can't even raise two or more kids. It's very hard. It's tough economy today. I think it's gonna get worse because AI will provide, like more automation, which means we will need less people. So the labor price will keep going down, and so also the global competition, immigration. Immigrants are basically adding to the current labor supply. So more immigrants coming in, the lower the labor cost will be individually. So that's what it's like. Like we can't do anything. We can't fix the system. We can't do anything. Like this is what it is. Like I don't know how it's done this way, but all we can do is protect ourselves. I don't know what I can do. I can only tell my friends, you have to collect assets, spending less money on, depreciating assets, like buying new car or buying electronics. Those are all waste. They should save money, and with that money, they should invest in, stocks or gold or something that is appreciating over time. And because we cannot have the labor, our labor is limited. When we are 60 and 70, we can't sell the labor. We have to rely on something else, and that should be asset. And people should understand this, how the economy works, instead of watching TV and what the media narrative says. That's all lie. That's comforting lies. And I think it's good that some of you guys here are already understanding the system, already on the side of the fast track, because most people are on the slow track and they are suffering. And I think we really cannot do anything. Only educating people, financial literacy is, I think, something that more important than what people study in school. But school never want to teach that. I don't know why.
You know, and before I really speak on that part, that was definitely like a lot of truth bombs there, and on a lot of notes. I was actually just about to put a pot on, Alicia. Did you want to say something? 'Cause I know you felt some of what he was saying as well. I don't know if you want to say something while I put this pot on really quickly or not. You have any thoughts?
Yes, I'm really enjoying the conversation, just listening. There's so much like-mindedness, and in what you're saying, and what our group is about. Um, it's reality, it's real, it's here upon us. And, I do agree, there's so many people that need educating and educating the right way. There's so much misinformation, and there is a way to combat some of it, and it's actually in what, Deron, what this room is about. So it's rare that someone like you come on stage and basically have the same mindset and, if you will, that we have as far as the economy and, where we're headed is concerned. A lot of times that, people with their own agendas. So it's definitely refreshing to have you. And I like to run. You're welcome anytime to come back and share your knowledge with us, and we'll do the same. I do believe that if we continue to go higher and higher and higher, that it's going to pop. It is going to get worse. What would that look like? I don't know, but it's scary. It's really, really scary. But I'll land my plane.
Yeah, definitely, Alicia. And the thing that makes it worse is one of the things that he mentioned is like we have to think about who owns all the assets, and sometimes sometimes it bothers my soul sometimes, right? And I'm sitting there and I'm like Lord, it's the amount of the appreciation, who can keep up with that? Like just from a norm, just like just a normal everyday person who can keep up with that. Like you said, you got two parents working, only one child, and they still can't afford the home, right? Well, of course. I mean, look at the rate of appreciation in the value of assets, and things that we should be able to own. We we fall out of that that ability, like we're kind of having to give up the thought. See people say, hey, yeah, I was gonna buy stocks, but man, they're so high right now. I don't know if I want to get in now, and yada yada yada, and they don't really understand the market much, and just getting started and getting involved, and even if you take this moment to start to learn and understand it more, whatever it's going to take, whatever it is, getting involved. But so like a lot of people have that issue. But I've talked about this before, Hung, and like I think one of the biggest issues with getting more financial educations in our schools. By the way, let me pause on this real quick. Corporate profits plus 9.5%, 9.05% year over year. All right. This is the third quarter. Strong acceleration relative to the second quarter. And so this is what I was basically talking about here. So those, like corporate profits, those types of things are not slowing up right now. But
have not.
Right. We had this session a long time ago. I need to go back over those numbers. But I think it was like the top 10% own 70% of the market or something of that nature. Something around those numbers. So and I think another thing is people not understanding the difference between business ownership and entrepreneurship, right? Those things as well. It's like you can also, in being an entrepreneur, you can also, just like any of these other guys, buy some of somebody else's business. Like invest your money, well across these other spectrums. If you're gonna be an entrepreneur in today's society, don't be the entrepreneur who's 100% betting on your own company. When I was studying financial markets, this was one of the things that Robert Schiller said. He said, it always shocked me that more people didn't like bet against the companies that they work for. Right? He's like, well, if you really think about it, you're totally 100% dependent on that company. So if they go down, you go down, right? But what if you work for a company that's publicly traded, you know, if every once in a while you took that small percentage of your paycheck and um, you bet on these down periods, then when they're doing well and you're getting paid, and that's cool. And but when they're not doing so well, you get paid overtime. You know, it's like that. But from an entrepreneurial perspective, so many people that I know, they put everything, they put their all into their businesses, and they don't realize, like, hey, you could own other businesses, right? Like that was actually another one of my smaller projects that I started early on, Alicia, by the way, was I wanted to actually build portfolios for businesses, and I built portfolios for a few businesses, but I'm not really truly ready to get into that side of things yet. But I started off with a few just to get a feel for it, and and really grow to understand these guys, and that worked out, because I was able to talk to them and say, okay, so what do you do with your, like, what is your company own? For most of them, their company didn't own anything at all. All right, some of them at least a storefront, or these types of things, but what did it really own besides the cash holdings, and the intellectual property, the client lists, and that kind of stuff, right? They a lot of intangibles, a lot of intangibles. And I said, okay, have you ever thought that have you ever thought that your business can own a part of other businesses, right? And because I'm like, okay, cool. You took a step forward. You took a leap. You as an individual, this is a part of the wealth mindset. You stepped into the entrepreneurial mindset. That's a part of a wealth mindset. Great, right? So you want to be more like these wealthy individuals out here. Okay, cool. Now, if you imagine that 10% of them own 70% of the market, then that would stand to argue that a ton of these entrepreneurs would have to own a bunch of other people's businesses, which is how they get over. Right? Look at all these companies. What are they always doing? Investing in another person's company, investing in another person's company, investing in another person's company, sometimes buying the whole thing if they can. And letting those people continue to run the company, but now those profits are coming to me, and I get to decide what to do with it, right? Um, like these little things that we have to really start to and get more of, and back to this thing about like the school thing is like, I think one of the things that's keeping schools from having that major break and having more teachers on staff for teaching financial education is the pay, man. I've talked about this before. Um, you know, you got guys who go to learn finance, right? And they're learning about multi-trillion dollar parts of the global economy, right? and they know that they can go out there and get their piece of that. And then we're saying, hey, but how about instead of going out there to make your millions, you come and teach and make, less than the average person makes per year. Right? And that doesn't work out so well. So some people are humble enough to do it, other people are not. So we don't get a lot of teachers going. You don't get a lot of financial professionals going into teaching. That was actually a part of the reason why I wanted to do it, because I was aware of this this issue that we're dealing with. This problem that we have. Which is just not being able to incentivize these teachers, to have some really great education. Now the colleges can get them in there, right? Because the colleges can pay them lots of money, but for primary and secondary school, right? We're not offering these guys enough to have a program all across the countries all the time, and that sucks. That's the part that really sucks. So we got to do more of this, and that's the case, and that's what we'll do. And then we have an each one teach one attitude, and so hey, if you're learning something here, pass it on as much as you can. I know how it is. It's like, hey, okay, cool. I'm still learning, so I can't teach you everything, but I can teach you a little something, and so I get those things, but. And that's why I try to teach the simpler ways of doing things in that way, and not the simpler ways of doing it per se, but like putting the simpler narrative on it, right? Because simple wins in this game anyway. But teaching it in a way that makes it that much more easier to pass on, I think, is what I'm getting at, right? So.
Yeah, you mentioned here, understand on any level, and that's the difference. You don't talk above our heads. I will say, bring it down, Deron. So we can understand it.
Definitely. But anyway, guys, I'm gonna go ahead and I gotta close out right now and go prepare for my call. I got a call coming in at 1 here, so I'm gonna go prepare for that. But it was a really great conversation today, Hung. Much appreciated for everybody that that stuck in through the conversation. Hope you guys picked up on some things. Hong asked some really great questions. He also passed on some really great knowledge of his own as well. So definitely looking forward to tonight. So that way we can talk about these stocks. Alicia, there goes that underperformance of IWM and Dow Jones. I knew that. Yeah, I knew that. Yeah.
You called at 8 tonight.
Yes, ma'am. 8:30 tonight. We'll talk about some of the names for 2026 and what they may mean to us for next year and how we can how we can take them into next year. Savannah, please leave her alone. All right, yeah, I'm done. it's beginning. Hall, do you have anything that you want to say before we close out?
I want to know what time this will be tonight. It's actually night time.
Yeah, it's 8:30 Eastern. 8:30 Eastern. Yeah, 8:30 p.m. Eastern. Right. Alicia, Prince, anything y'all want to say before we close out?
We'll see you tonight.
Wow.
All right, most definitely appreciate it, man. All right, guys, I'll catch up with y'all later. All right, Kenneth, I see you over there. Mojo, I see you over there. Later, guys. Better be blessed.